so we can gradually start the next session. So after the academic part, the main conclusion is that it's not completely hopeless. So let's hope that this similar will hold also after the next policy session. So I would like to welcome our next panelist, chaired by Maria Nikanen. So the floor is yours.
Thank you. And I can say good afternoon to everyone, ladies and gentlemen. So in this panel, we have an excellent opportunity to discuss national experiences on macroprudential policy and lessons learned from the recent challenges to policymakers. We have panelists from 4 different euro area countries with experience on macroprudential decisions in different roles. To start the panel, I would like to raise 3 interrelated themes as starting points for the discussion. First of all, over these years we have experienced very different phases of financial cycle. After the global financial crisis, the euro area financial system saw signs of credit growth for several years. The cycle peaked in early 2020s and has now been contracting a couple of years. Obviously, the challenges of macroprudential policy have reflected the phase of the cycle, and at the same time, cycles in national financial systems continue to differ from one country to another, even within the euro area. Second, increasingly during the last few years, the financial system has faced several exogenous shocks. The start of COVID-19 pandemic and the economic impacts of unjustified Russian war invasion to Ukraine are prime examples of such shocks. The macroprudential policymakers face the question how they should and how they really are able to react with macroprudential tools in front of potentially very systemic but surprising shocks. Third, over the past 10 years, macroprudential policy has been conducted in 2 clearly different monetary policy regimes. Most of the time, the interest rates have been low, and monetary policy operations provided the market with ample liquidity. With a recent surge in inflation, monetary policy has been quickly tightened. Prevailing monetary policy has obviously had considerable effects on the financial system and macroprudential risks. Within the euro area, the effects of common monetary policy may have been heterogeneous across member states, also given differences in financial systems. So, against this background, I would like to give the floor to the distinguished panelists and ask them to share their views and experiences on the macroprudential policy and possibly raise the most relevant lessons from their perspective. I would request the panelists to stay within 12 minutes time limit to leave time for discussion, questions and answers. And I suggest that we start with Governor Gediminas Šimkus, Chairman of the Board of the Lithuanian Central Bank. And as you said in your intervention question in the morning, you said that you are a financial stability person. So please, the floor is yours.
Well, I started my career in financial stability, but I was joking with Marek that don't throw your glasses at me if I would say monetary policy instead of macroprudential policy now. But thank you for this very nice introduction. I would like to begin with thanking also Narodna banka Slovenska and Suomenpankki for this very timely conference. And it's my great pleasure to be here and share the experiences of how we in Lithuania implemented the macroprudential policy framework. When discussing with my team what are the lessons, we basically return to the very essence, and the previous panelists presented like this academic research. Who is controlling the slides? I don't have the controller.
Yeah.
Oh, it's here.
Green one.
Green one. But I will refer to Hyman Minsky's ideas, but why? Because in the classical economics, it assumes that markets are fundamentally stable and that they seek for equilibrium. But what we have seen in the last decades of last century and in the beginning of this century, that this does not exactly be true. And as Minsky outlined, financial cycles are psychological in their nature. So in boom phases, people, companies, lenders and borrowers, they do remember what has happened in the crisis. Their memories are very vivid, so they are cautious and very careful, and therefore the amount of debt, like accumulation of it, is limited. But as the financial stability continues, and it prolongs, so the market's confidence grows, and this leads to gradually, but step by step, to more excessive leverage, and this disregards the economic fundamentals, and then boom, you have financial house of cards built on extrapolative expectations, which are fueled by the leverage, and eventually you have so-called Minsky moment. Then the market falls to its fundamental value. So first lessons, and here where I agree with Minsky and disagree with what with some discussion in the previous panel, that what we could learn from this, what's the major insight, is that financial market by itself lacks self-stabilizing properties, and this is where the first lesson. This is why we need macroprudential policy, and that macroprudential policy works. Okay, now I go to the Bank of Lithuania, and actually in the EU we do have macroprudential authorities by law. Having said this, the frameworks, the setups, the measures, and the policies are very different. So, for instance, in my country, in Lithuania, we do have single macroprudential authority. This is Bank of Lithuania, which means that the macroprudential powers are within institutions. So there is the distance between identification of the problems and finding the solutions and the implementation is lower, it's speedier. And it's also reflected in our real actions. So we were one of those first countries which introduced borrower-based measures, not like as recommendations, but as requirements for banking system. We also were one of those first countries which introduced the positive neutral countercyclical capital buffer. And if we will have a possibility, we can discuss this further. And we also are micro supervisors, so we can align our macroprudential and microprudential policies, and I clearly see the benefits of it. So what are the lessons? So I will not dive into our measures, but I will concentrate on the measures, on the lessons. And then we discussed, actually we found many lessons that we would like to share, but it will take more than 12 minutes. And given this, so we distilled the essence and get rid of some, so I will focus on 5 lessons. So first, 10 minutes left. Macroprudential policy is not about what you will see now, the results now. It's about policies which lean against the cycle, or the policy which needs to be implemented early in the cycle. And it's required to have strategic patience to see the benefits of the policies implemented. Having said this, we are in the EU, and I would say there is a very delicate balance between the policies at the EU level and what's required at the national level. Third, it has been mentioned already, data. Data is the king for the decisions, for the policies to be well calibrated and implemented timely. Fourth, I believe there is a very strong need for a clear owner of the policy. So we don't argue, should we have a policy for an owner of tax policies, or who is the owner, or what institution is the owner of foreign policy, social affairs policy. Sometimes you may find questioning who is really responsible, or who is the ultimate, who holds the ultimate responsibility of a macroprudential policy. And then the owner of macropru policies should have this holistic view and prevent policy leakages. And now I will go one by one. So learning against the cycle and having early implementation of macropru policies for them to pay off. It's, as I said, it's about the strategic patience. It's about building the reserves, building the credibility in the system, which requires time. And a couple of examples. So Lithuania is the country which was very severely affected by the global financial crisis. So in 2009, our GDP fell by 15%. What we learned from this, so we introduced borrower-based measures afterwards. But we also calculated if those measures had been in place before the global financial crisis, we would have reduced our mortgage portfolio losses by 80%. And another example. We were living long time in a negative interest rates environment, meaning that interest rates were very low, and the absolute majority of the loan portfolio in Lithuania is floating rates. I mean, what we see now with the 10th consecutive hike of the interest rates, of course, this transmission channel of monetary policy is very quick in my country, in the Baltics. In 2015, seeing that there is no way just to see one day interest rates rising, we came up with a solution that we need to introduce one measure. So this measure is interest rate shock. So you measure, or you try to evaluate and assess the capability of the borrower to repay the loan when interest rates rise to 5%. We introduce it, and luckily we have this measure, and this is the time it pays off, because with this sharp rise of interest rates, we see that at least so far, non-performing loans portfolio of the banking system is low, also implying that it's not that NPLs are low, but the borrowers are capable to repay their debt. So my task here is not to overwhelm you with numbers, but just to underline that this policy requires strategic patience, because it needs to be implemented early in the cycle. At that particular point in time, you may look like you are spoiling the party. You're introducing something that doesn't have clear, visible effects right at the moment of implementation, but eventually it pays off. Second thing is that we do have a mixture of EU policies, of what's regulated at the EU level and what's done at the national level. And here, we do have capital-based measures, and we do have borrower-based measures, like two lines of measures. What regards the capital adequacy measures or the capital measures, so it's like the system is at the EU level, and we do have like this dual implementation. We do have European Central Bank, and we do have national macroprudential authorities. And I think this interplay works pretty well. We need to make sure to ensure the single market. So this policy works, or this dual implementation works pretty effectively and efficiently. But here as well, some agility is very much needed. And for instance, we made use of this agility implementing or having increased the systemic risk buffer applied only for the mortgages to 2% to solve these the weaknesses in this particular market. A bit different story is about borrower-based measures. We do have single market, but we don't have single borrower-based measures regulation, and we do have very different borrowers' rights, or so to say, or requirements on when they come to loan, when they want to get a loan. Is it a big problem? that's what I'm not sure, because in Lithuania we have implemented borrower-based measures. But given this is a single market, I believe that there is certain need for uniform definition, at least definition in the level of definition. How we continue with borrower-based measures. Having said this, implementation is again in the hands of national authorities, and should be there because of the needs of, so to say, of taking into account national specificities. Data is the king. It was already mentioned. It was already mentioned. Data issues. Of course, we use various data from various sources, but for the effective and efficient macroprudential policy is not enough to deal with these statistical aggregates. Credit registry, we do have it in-house. It has very granular data on loans from credit institutions. But having said this, data is a big issue for macroprudential policy, especially data about the developments in the real estate market. Yes, we do have statistical indicators of changes in prices of housing, but devil is in the details, and because of the specificity of the real estate market, you can't buy, just the number that you have for the growth of houses, for the price. You can't take just the number which is house price index, because there are many specificities you need to take into account. So it's very much needed. The other thing is the responsibility of macroprudential authority. I mentioned that we, Central Bank of Lithuania, have a clear mandate for macroprudential policy. But I need to admit that this is not exactly the case in other jurisdictions. And very important, so the lesson we have, so it's very important to have, so to say, this very clear understanding which institution is responsible and accountable for the policy, and not mixing up with various objectives and functions of some other policies. So there is an upside of the approach when you have like a bunch of people deciding together what's needed for Macropru. So you take a broader scope, you take into account various aspects, let's say housing affordability, when you consider the, let's say, prudent lending requirements, and et cetera. But there are many downsides of this too. Because if you miss the objective, you dilute the policies with many other objectives, or you delay the decision. Eventually, you have just risk growing and finally coming up. And then finally is the prevention of the leakages. It's a serious business. At a broader level, macroprudential policy is more or less focused on the credit institutions. And it's very clear. It's very evident that you see some activities leaving the credit institutions and going to other parts of the financial system. For instance, mortgage lending. So insurers became more important mortgage lenders. But coming back to the country level, to our national experiences, that we consider as an achievement. The achievement that we follow the activity-based approach. What it means that it doesn't matter which legal form they grants the loans, but if it is a mortgage loan, so we apply our macroprudential requirement on that specific activity. Well, I will jump my next slide, and we'll take you to the last one. So, to summarize, macroprudential policy continues or is facing the trade-off between the short-term visible costs and invisible positive long-term effects that are spread across time. And to minimize the short-run cost and increase long-term benefits, the lessons I outline, I believe they are important. And I would like to stop with the quote by Milton Friedman. It's a bit, I rephrased it, but still, the widespread invisible effects are often much more important. And these effects, long-term effects, are positive in the implementation of macroprudential policy.
You almost did it. Thank you, Governor. I think that you very well set the scene for these experiences, and thank you for sharing your thoughts. But next we move to Katja Taipalu. She's next one on in line. She is head of financial stability and statistics at the Bank of Finland. So Katja, please.
Thanks. Can I have the
pointer?
Yeah, excellent. Thanks. So I would like to draw attention to the 4 points concerning the national experiences, what we have learned from making the macro-prudential policy decisions. And I think that I will skip this one and go straight to the first slide. So the macro-prudential policies are never done in a vacuum. So you actually need to take into account many different kind of things that are going on in the surrounding. So macro-prudential policies do intervene with micro-level regulation, monetary policies, fiscal stance, and things like that. But the most important thing during the last years has clearly been the monetary policies. And especially in the euro area, where we have the aggregate level monetary policies, it's clear that it's not always optimal to all of the countries in the euro area. So promoting the financial stability and financial stability conditions would actually require to be very active in a macro-prudential to get the stability conditions good. The problem might be that the monetary policies is a very strong policy. So you actually need to have proper and strong tools also in the macro-prudential side in order to have an impact. And why it is, and that's clearly why it's really important to have the national level macro-prudential policies when you have the aggregate level monetary policies in the euro area. And besides the monetary policies, things always are a little bit different. So you do have different kind of structures in the financial system. You do have a little bit different phases of a cycle. So those all points relate to the national level of macro-prudential policies. But in order to be, and I'm mostly talking about the euro level stuff now, but besides having the national policies and national decision making, it could be useful to have common definitions about the tools and the principles, how to use them, so that they could be a little bit more aligned probably. And one thing is that if we think about what have become evident during the last couple of years, is that the transmission channels of the monetary policies, especially in the euro area, they are not the same in all countries. We have variable regime countries, we do have fixed regime countries, and clearly the transmission is completely different in these cases. But of course, the sound banking system, which the macro-prudential policies also promote, is very crucial to have proper transmission of the monetary policies as well. Then the second lesson I would like to point out is for effective and well-targeted policies in macro-prudential, we actually need the adequate tool sets. And this relates to the level that we're targeting at. We're usually talking about the structural risks or cyclical risks where we target the macro-prudential policies. But the level should always point to the structural risks. And I think that what we need is actually clear rules how to make the macro-prudential policies. And this goes to the build-up phase of the buffers and macro-prudential policies, but also when we want to release the buffers. And I think that this has very important point also related to the communication and giving basics and fundamentals to making the policies, because if you can give good understanding about the grounds why you make the decisions, it's very crucial for the acceptance of the policies. So what we learned from COVID was that not all the systemic risks are such that we can point out from time series, for example. They can come from the outside external shocks, and then we should have space to react on. And the current tools are a bit troublesome in the sense that they are usually linked to different kind of risks. And what we would need is actually something like the positive neutral buffer. One thing related to making the efficient policies always relates to the implementation lag. So in order to make timely policy decisions, timely actions, you actually would need very timely analysis. And that's the great challenge to making the macro-prudential analysis. One thing that we have tried out lately has been the scenario analysis. So especially in the cases where the future is very, very uncertain, you actually need to build up different kind of scenarios where you're heading up. And then you can try out different kind of use of different kind of tools, different kind of combinations, and try to find out the right combination of different kind of tools in order to have the optimal impact. And in case of the impact studies, I think that what we still lack a lot is the impact of the true macro side of the macroprudential policy tools. Because many of the tools in macroprudential policies do have an impact to the sectors and operators which are very, very important for the overall economic developments. So banks, real estate sectors, households, and that's something that we still need to cover a bit deeper. So impact to the real economy needs to be well understood. And then related to the preconditions for successful policies. Like I mentioned, one of them, and that's very in the core, is good analysis. Timely analysis, but also good analysis. And by good analysis, I mean the analysis that actually can pin out the true structural or cyclical risks, but the systemic risks. And it's not always very easy, especially to spot out the systemic dimension of the risks. And that's where we need data. So we need to understand the interconnections, correlations, and interdependencies in order to understand truly the systemic dimension of the risks. And for that, we need data which is wide, deep, and combinable. And of course, use of that kind of data means that we should have a lot of micro-level data. But the micro-level data should be brought up to the macro-level messages. And that's not the easy part, because in that, we do currently need a completely different kind of skill set in order to build up the messages from the micro-level data and bring them to the macro level. And concerning the importance of the interconnections, one thing in case of Finland has been that we do have very integrated financial system with the Nordic-Baltic area, and understanding truly the interconnections and contagion channels, it's been really utmost important for our assessment of the risks. Okay, and then finally the communication. So I think that what we have learned is that it's really important to make the macro-prudential policies to be better understood by the industry, but also by the public. Because making them more understandable makes them more accepted, and it increases the legitimacy of the policies. And it also increases the well-placed expectations of the policy and the anticipation. That's all from my side. Thanks.
Thank you, Katja. Now I will turn to Benjamin Weigert, Director General of Financial Stability at Bundesbank. Benjamin, now it's your turn. Do you have slides?
No.
Okay.
No, I'm a dinosaur. I don't have slides.
Okay.
Thanks for having me here. It's a great privilege to tell you a little bit more about my experiences during the past 8 years in macroprudential policy at the Bundesbank. And the usual disclaimer applies here. Whatever I say is these are my personal reflections on the issue, and do not necessarily is an official position of the Bundesbank. Just to make that clear. So first, I do think that macropru was successful throughout the past years, but faced challenges. First of all, political economy. We talked about that already earlier today, and the micro-macro interaction is an issue we need to address maybe in the future. The first thing is, why do I think it's successful? Macropru, or the objective of financial stability, the policy objective, is now well established, and it's not necessarily the case that you just look at buffers that were built up in the past, but it entered the policy discourse. So whenever we have discussions at the national level on certain initiatives, they ask, what does it do to financial stability? So we are now also in the national policy discourse, not necessarily changing many things in the course of policy making, but it's in there, and we provide our perspective. So I think this is already a success, that financial stability as a policy objective is something that is already part of the thinking of politicians as well as policymakers. Second, what we did during the past years after establishing macroprudential policy was a build-up of analytical capacities, and the build-up of analytical capacities served us quite well during the pandemic. During the pandemic, we were able to use our analytical capacities to support other policy areas in guiding them where frictions might arise due to the completely unknown nature of the shock, and how successful this was in the EU was also established by the working group of the ESRB, where they looked at the fiscal policy or the financial stability implications of fiscal policy. And this close interaction wouldn't have been possible without establishing financial stability, at least to that degree. And also in a monetary union, I think this is also something that is a main learning from the pre-crisis or pre-financial crisis, is that the real interest rate as a main factor or one of the main factors of the financial cycle differs in a monetary union of otherwise sovereign states. So macroprudential policy really serves a purpose here in identifying and addressing the buildup of vulnerabilities and imbalances, financial imbalances in the monetary union. So from that perspective, it's also good that we have, after the strategy review, now the formal interaction between monetary policy and macroprudential policy in informing monetary policy about the possible implications of monetary policy on financial stability. So what do we know in terms of the more visible element of macroprudential policy, the buffer build-up of cyclical buffers? And there, and I agree with previous speakers, we need to be early in the cycle. We need to build them up early, and it's actually cheap if you build them up early. There's some research that will also be published as a SURF discussion paper. It's about to come out. It's a joint work of colleagues from Bundesbank and ECB, and they show in a formal setting how important it is to be early and how low the costs are of increasing buffers and how big the impact is by preventing deleveraging later on once a large shock hits the economy. One thing that was not so much discussed this morning in terms of the impact of buffers is the implications for risk reallocation in the system. So heterogeneity in the banking sector plays a role in when it comes to setting buffers. Because usually, on average, there is enough capital headroom, but there's in the tails, you probably have banks or institutions that take too much risk by operating next to their capital requirements, and by introducing the buffers, you somehow initiate a substitution of credit within the system, and this also reduces probably the risk for the banking sector. That is something we learned when introducing buffers in Germany. However, we were not that early. I think this is something we learned. I mean, Martin Hellwig mentioned Germany several times as a bad example. I'm not sure if that is right, but if you look at Europe, I think we all learned that there weren't enough buffers once COVID hit the economy, and this is quite visible by the fact that it was the Macroprudential side that provided the capital headroom during the pandemic. So 15% of the headroom that was provided by supervisors and authorities was macroprudential. The rest was microprudential. So it means we need to be better in building up buffers early. I mean, this also maybe initiates the discussion about the positive neutral rate, which also carries some issues with it. The question to what extent banks perceive this buffer as permanent or temporary. This will have a lot to do with the way how the banking sector will react to it. But that's also for academic research to provide some more insights. But the main issue is a political economy of macroprudential policy, and I will turn to that. Raising buffers in good times is usually opposed by the banking sector, and Stefan also already alluded to that. It's never the best time, or it's never a good time to increase buffers. And while I agree that we need good data, that's usually what the banking sector says. The data is not showing that you should increase buffers. And then they ask for more data, more analysis. And I think that's one of the things that we need: good frameworks, good policy frameworks, good communication to be early in the cycle. But it's a really an uphill battle to convince a well-connected sector, politically well-connected sector, that it's important to increase resilience. Even more challenging is the area of borrower-based instruments. I had the privilege of asking the Parliament together with BaFin to introduce a legal basis, and even that was already an uphill battle. Out of 4 instruments, we got 2. And the reason why we got only 2 was because we don't have the data to set the others. The other 2 was the income-based measures. At least the data, the data was also, or the found a legal basis for data collection was also established. So at least we have the data now, and maybe in the future we also get the borrower-based instruments, the missing 2. But it's obvious why it's such an issue. It's because you tap into highly political water, and it doesn't matter which part of the political spectrum. Housing affordability, all this is really a hot topic. It's an important topic on the policy agenda. So as I said, it's important to have good data, but it shouldn't be just be related to data. We need good analysis, and we need a good policy frameworks that are communicatable. And in this regard, I'm pretty happy to have the ESRB and also the ECB as the platform to share best practice, to share experiences. And this is also one lesson. We should empower these institutions to make national macroprudential policy more powerful, more and better. Last point, micro-macro interaction, which is also a challenge. And it is a challenge on 2 grounds. The first is on the policy objective, and we already had the discussion in the earlier session. From a micro perspective, it's all about solvency. But if you talk about financial stability, financial stability is already threatened long before solvency is an issue, simply because you have these negative feedback effects for the real economy due to deleveraging if a sector is entering survival mode and trying to prevent breach of capital requirements. So in terms of the policy objective, this is really challenging because during the past years, we've learned that in interacting with our supervisory colleagues, which is always very helpful, that was the center of the debate. How much capital is needed for the system? Is the main objective solvency, or is the main objective financial stability in the sense that the system is not having negative externalities to the real economy? The second thing is in terms of communication. We use instruments that are micro instruments. We ask for more capital surcharges, and this usually is perceived by banks as something that is related to their individual either deficiencies or a certain exposure they have, or a certain risk. Certain risk they have on their balance sheet. So it's something they can change by changing individual behavior. So they can reduce their risks, and then capital surcharges will be reduced. This is not the case for macroprudential tools. Macroprudential tools depend on the system, so it's not that an institution, that a bank can change behavior and thereby reducing capital requirements. And this is a challenge also when we talk to the sector. And I think it's important that we have good macro exchange with supervisors to explain to each other what's the rationale behind a certain policy action, and also inform micro supervisors about the macro environment and how this relates to the risks on banks' balance sheets, and vice versa. So it's not the one-way road in this case, but it's really an exchange which helps to make macroprudential policy and microprudential supervision maybe a little bit better and easy and better communicatable. So For me, the main message is, and the main message from the experience so far is we need a very good ESRB as a platform for sharing best practices and also evaluating macroprudential policy. I think it's a benefit that we have basically a single rule book, and we use it at the national level. And this offers a lot for empirical analysis. So we should use that more. This would be my first wish on the wish list. Second, also a very proactive ECB, because the ECB has a special role to play in the banking union. They have the top-up power and should be more proactive in communicating their concerns when it comes to national vulnerabilities, and at the same time also be proactive in communicating potential spillovers within the banking union, which could also be a reason for increasing or using the top-up. And the last point, macro-micro interaction is key to me to make sure that we communicate our macroprudential policy better and have a better understanding of the interaction of both policy areas. Thank you.
Thank you, Benjamin. Very interesting viewpoints. And last but not least, we will hear the intervention of Marek Lisak, who is a director in the Macroprudential Policy Department at Národná banka Slovenska, National Bank of Slovakia. Please.
Thank you, Maria, and also thanks to organizers for inviting me. I'm really honored to be part of this panel. Title of the conference is about looking back and also looking ahead, so I will try to cover both aspects of macroprudential policy, but the major weight will be put on the looking back. Javier, you mentioned at the beginning a risk of repeating. I'm the last in the second panel, so the risk is potentially high, but I think great advantage of this panel, it's a national panel. Despite the fact that we are covering approximately the same period, also talking about the same system, we have EU framework for macro policy, I think there are still huge differences. How we use buffers, how we use different tools, and also differences between our experience. So I hope there will be not so many overlaps. Okay, I have a good position to see my slides. That's fine. I will start more generally. Macroprudential policy is relatively young policy. Title of the conference is saying about 20 years of the policy, but we know that it's real policy only for last 15 years because it started to be more active after global financial crisis. So it's still a rather young policy, especially if you compare with monetary policy or other structural policies. But still, I think that this 15 years window provided us with a lot of good experience and good lessons. So we already know much better what are our tools, how to use it, also how to calibrate it. We know much better how to analyze systemic risk. So I think this 15 years period was a very successful story. So I'm really a big fan of macroprudential policy. But there are two things that I want to mention, and they are not so commonly discussed on such forums. First thing is that introduction and implementation of macroprudential policy is also very important intellectual shift or change. And that's not my idea. So if you don't agree, you can blame Claudio Borio. That's his idea from one of his speeches. And that means that there are two very important dimensions of macroprudential policy. First is that it's a preventive policy, so it's a forward-looking policy. And second, that it's a cross-sectoral policy. And that's something that you don't have in this previous system. So if you think about the financial stability system before global financial crisis, so that's a significant change because by introduction or implementation of macroprudential policy, we change our view how we understand the risk. because before, risk was understood that it's something that emerged during the bad times. But now we see that the risk is emerging during the good times, and we should do something, we should be more preventive. So it's a very important change. And Claudio Borio is also saying that what he sees as a very positive, that this idea is also spreading to other policies, fiscal policy, monetary policy. So from this perspective, I think that's a very, very important change. Second change is, okay, that's my idea, so now you can blame me. I call it cultural change, and that's something that is more relevant for central banks and also for institutions or authorities responsible for macro-prudential policy. Simply, it's a shift from being analysts to policymakers. Simple sentence, but very, very difficult and long story behind this. Because it's a one story if you write analysis just as a researcher or as a just analyst and publish it. And second story is if you have a responsibility. If market knows that you have a powers in your hand, you can influence something, and if you introduce something, you can have a huge and far-reaching consequences or influences on different sectors, household sector, banks, and other sectors. And within this 15 years window, that has changed. I remember our first decision, that was in 2014, when we first time introduced package of borrow-based measure. And there was a very, very difficult discussion in the bank. Not so much in the public, in the bank board. I remember that day when we had this discussion, many members of the board were asking, do we really need these changes? Look, there are very low NPLs, the provisioning is very low. Why we should come up with such solution, such a painful solution? Now, when we have a discussion at bank board, in the bank, discussion is very different. So after these 15 years, culture has changed. Not just in our institution, but also in the whole society. We also have some people from journalists here within the audience, and they could explain that now when we are talking about changes in borrow-based measure, or some measures from a central bank perspective, there is a much more understanding in the public. And I will explain later on why, or possibly why this is the case. Okay, at the end of the slide, I have a picture just to show that this cultural change is really something that we take very seriously. So you can see that we have implemented several measures. We started in 2014, several rounds of recalibration, also tightening, and also we introduced several buffers. But I don't want to go into details of individual tools, because behind every point is a specific story. Okay, so now let me continue with this policy making. Okay, now we are on the next slide. I think all of you mentioned the importance of the data. Well, just to agree, that's extremely important to have a good data. But let me stress one aspect of the data, and it's use of individual or granular data. Well, in the past years, we have invested a lot into getting such individual data. So just to give a short overview, we have basically individual data about the households, we have loan tapes, we have also limited access to social insurance, so we can see updated income. We also have access to different samples from the statistical office. So we basically see the full picture of the household's financial position on the individual basis. Almost the same picture we have for corporate sector. We also have data for real estate sector, so not just averages, but every individual advertisement, also a relatively long historical time series. So, Gedemin, as you mentioned, data is king. I think if you have this data and you know how to use it, you are a king. And I'm very glad in the past we invested a lot into individual data. And that's a game changer. Because once you have individual data, you see the whole story. It's not just about averages, about general trends, about sectoral trends. This could be a good indicator. But to see or to understand where the risk is, you need this individual data. And I'm very glad that we have it, and that has really far-reaching consequences. That has an impact on the way how we do monitoring, because basically the whole monitoring is based on individual data. For example, now we have an issue with commercial real estate. We can go directly on the level of individual projects. We see the balance sheet, the income statement, we see exposure of the bank, we see parameters of individual loans. So you see the story. So it's not just story from newspapers that I have a feeling that there is a risk, but you can confirm it. Just to give one example, I hope still have a time. Next week we have elections. You probably saw nice billboards with smiling faces. And one of the topic of pre-election discussion, a major topic, was rising interest rates and the impact on household borrowers. Some parties came with the idea that because of rising interest rates, tens of thousands of people will lose their houses. So we should do something. And now political parties started to come up with some solutions like subsidies or interest rates. Central banks should set interest rate and be responsible for interest rate. We should have a bank levy. So many potential proposals that could jeopardize or influence financial stability. So what we did, we used all this data, we prepare analysis, very detailed analysis. So, and we were able to show that impact, there is of course impact, but very negligible. We were able to show which categories of households are vulnerable, which are not. We provided also data, how many households will be influenced. So very detailed analysis, and I don't want to say that we killed this topic, but now this topic is much lower, and mainly because of such a open and detailed analysis. Okay, that's about data, but I think there is an agreement between all of us. Second topic is about communication. If you want to be good policymaker, that's one thing to have a good idea, good understanding, also to have a tool in your hand. But we know very well that the most difficult part is to sell your idea. Like Benjamin mentioned, you can have a good idea, but if politicians do not agree, you will not succeed. And we are politicians. So we have to do everything to support also this last part of the policy making. And frankly speaking, I believe that this communication is still very underestimated part of the macroprudential policy. It's almost state of the art in the monetary policy, but still underdeveloped in a macroprudential policy. Very quickly, what we do, there are two, let's say, layers of communication. First is very active discussion about risk and the trends. Why it is important? Because if you explain risk and the trends, and also what can possibly happen if these dangerous trends, risky trends will continue, you can end up in such scenario, and you can end up in such a crisis. When we come up with concrete proposal, borrow-based measure, we usually provide very detailed cost-benefit analysis. And usually by this first phase, we prepare the ground for possible activation of borrow-based measure. So I think part of the reasons why so far we have been successful with introduction of borrow-based measure and why there is no such a strong resistance in the public is because of very active communication and explaining to banks, to public, to journalists. That's extremely important. Second thought in this slide is about macro-prudential policy. It's a very complex policy. Very quickly, sometimes on some forums, I have a feeling like macro-prudential policy is just about capital buffers, borrow-based measures, maybe some data indicators behind this, and that's your business. Don't care about the rest. But that's not true, because macro-prudential policy is very complex policy. If we are talking about systemic risk, it's not just about lending interest rates. It's also about taxes, fiscal policies, regulation in other areas, also about resilience. So it's a very complex picture. And that means we need all this information. And okay, that's one of the part of the business or of this framework that is still a little bit lagging behind, because there is some cooperation, but it's still somewhere at the beginning. But it's very important to have it really this complex view. Okay, one slide about lessons that are related to tools, not just borrow-based tools, but also capital tools. I think, Gediminas, as you mentioned, that it's very important to avoid leakages. So that's why it's very important to come up with a very comprehensive toolkit, not just in the legislation, but also when you introduce something. And that's what we have. You remember from the previous slide. We do it because of leakages. That's very important. But there is also one additional very important factor why it's important to have such a complex package. If you have such a complex package, basically you are more resilient to different types of the shocks. When we introduced this package in 2014, we had some trends, risk in our mind. But at that time, we didn't have an idea about pandemic situation, high inflation, war in Ukraine. But now we see that because of the measures that we introduced at that time with some recalibration, the whole portfolio is extremely resilient even during these new types of the shocks. So it's always good to have such a package implemented because you are more resilient to really different types of the shocks. Lessons learned related to unintended consequences. Well, that's something that, of course, we don't like. Also, politicians don't like it, and that's the reason why even they are so against introducing borrow-based measures. It always happens. You always have some costs. That's normal. Of course, there are also some unintended consequences. So you probably can reduce it to zero, but you can minimize it. So just to explain what you can face, for example, when you introduce borrow-based measure, of course, there is always debate that you are not allowing people to take a credit. There is a risk of migration to less regulated sector. You can cause market disruption. So all these factors are really valid. So what you can do? Again, we could possibly talk about every aspect and every disruption, but what's really interesting or very important is to have a good understanding of the risk and trends in the market. So before you want to introduce something, just make sure that you have a really good understanding, and that's about data and market intelligence, also some other sources of information. Very important when you bring some measures, especially borrow-based measures, it's very important to focus only on the risk that you can identify. So not just to come with broad introduction of the measures, and it's much better to focus on the risk. And in this case, you can avoid possible unintended consequences. Also, we also mentioned using holistic approach, and also very important to have a feedback mechanism, because once you introduce something, there is always some reaction. So to have a good reporting system, feedback mechanism, and to be ready to react if it's necessary. Okay, and the last two slides about challenges. So first about capital buffers, very quickly because time is running away. First about releasing capital buffers. I think we have a good experience with tightening of the buffers, but much less experience with the release of the buffer. There is some experience during the pandemic. I know that several countries release capital buffer just to allow some capital space for the banks and to support lending. Well, I don't think that answer is so easy. There are many questions, for example, about lending. If lending is demand constrained, not capital, you probably won't help so much. We were more cautious at the time, so we lowered CCYB, but only marginally, not significantly. The reason was very simple. At that time, it was just about the market turmoil. There were no losses. And there is a still long way between the market turmoil and losses. So we rather wait for the losses, and once we see significant increase in the losses, within one day we can decrease the buffer. Of course, other indicators are important, like level of management buffer, state of the economic, financial cycle, and also other factors. And the last thought about capital buffers. Well, we all know how important they are, but the question is, what's the role of the buffers in this new environment? A new environment, I mean environment of the past 6-7 years, where we had several shocks, several crises, like pandemic situation. Now we have a higher inflation, energy crisis, but there were no losses at all. And buffers are here for the losses. So I'm not saying that I want to see losses. Of course, I don't want to see losses, but if you think about this in long-term perspective, this could have an impact on the banks, how they see buffers, how they see the risk, and also on the behavior of households and corporates, because if they see that there will be always somebody who can come up and help you during the bad times, this could have an impact. Okay, and the last, very quickly, we have a new definition of bank run after SVB. That's a very important change, because this kind of vulnerability goes into the basement of the stability of the financial sector. Here, just one thought, very important for us to have a better understanding of the deposit side. And that goes not just to a new definition of bank run, but also central bank digital currency. So far, we have accumulated good knowledge about the asset side, but still lack of data about the deposit side. We have no individual data, just averages, so we should go much deeply in this area. And Maria, I think I will stop here.
Thank you, Marek, and thank you all for very thoughtful and inspiring interventions. My plan now is to maybe take a couple of targeted questions to our distinguished panelists, and then then maybe to make this a bit more interactive and see if our audience is still awake and wanting to ask something from our experts. But I will start with Gediminas, because you are a man doing both macro prudential policy and also monetary policy. How do you see the interaction between those two? What are the challenges and what are the in a way, any success story on that field?
Well, very good question. This is $1 million question. But I think the first thing to start with is to recognize or admit that this is two separate policies. And each of them is driven by its respective goals. So this is the financial stability and price stability for monetary policy. And of course, the interplay of these policies is observable, is evident, because these two policies work via the financial market and financial market conditions. As like this channel is common, so you definitely will find the interplay of these policies. So first, financial stability is precondition for effective and efficient transmission of the monetary policy signals into the market. And secondly, you can take vice versa view, and it was mentioned, for instance, today it was already mentioned, is the lend of last resort, is this a monetary policy instrument, or is it partly the macroprudential policy instrument, or any liquidity injection into the financial institution that helps with the liquidity enhancement in that particular institution, but it also builds or helps with the financial stability issues in general. But having said this, I think that even if interaction is evident, each of those policies should be conditioned on their own thinking about their respective objectives over short, medium, and long term. Of course, you're not naive. You take into account that you will have the effects on our policies, not only, let's say, financial stability on monetary policy, but also on social policies as house affordability in many ways around. But I mean, if you try to mix it many objectives at once, I mean, you won't do any of the policies in the right way. And having said this, the third point is that then, if you admit it, you should not put normative labels on the interaction and mixes of these two policies, namely monetary and macroprudential. It's neither good nor bad to have this interplay, and you might have situations that they work hand in hand, and you might have situations when they work in the opposite direction, because the success of each of those policies should be judged from the perspective of their respective mandates and goals. So that would be my answer.
Yeah. Okay. Thank you. And Benjamin, you mentioned in your intervention that you praised ECB and ESRB. This is a bit provocative question to you, and maybe if Katja wants to also give her views on this. But because what we hear often is the banking industry, they say that they don't have a level playing field because nasty macroprudential authorities in the Nordic countries are putting capital requirements on banks which don't exist in other euro area countries. So should ECB have some kind of say, for example, not only topping up but giving instructions or orders?
Short answer, no. Long answer is that I think, given the institutional setup in the euro area, where you have single monetary policy, but otherwise sovereignty at the national level, and with most of the costs of any financial turmoil in the country is more or less borne by the country. I think it should be at the national level to ensure resilience in the face of diverging cycles and so on and so on. So, and for the financial stability, from the financial stability point of view, the level playing field is a constraint and not so much an objective. And I think the institutional setup in the European Union is quite useful, that once you go beyond certain levels of resilience at the national level, then you have to consult the European Commission. So overall, I think the setup is pretty much suited to the institutional framework we have, and I wouldn't recommend something more than a top-up at the ECB level. The question is, what is the objective of the ECB in this regard? Is it about spillovers, something that originates at the national level but is not taken into account by the national level? But this is up to the ECB to set the strategic objectives in this regard.
Yeah. Okay, thank you, Benjamin. Katja, do you want to add, or do you agree with Benjamin?
I think I do agree with Benjamin on certain things, yes. So I think that it's good to have ECB and ESRB and their analytical capabilities to keep us a little bit on our toes on national level to question our analysis, because it's always good to reflect the analysis and have second thoughts. Have you actually covered all the things properly? The thing about what I said before is that I think that it's really useful to have national level policies and national level policy making, because there are structural differences between the countries. There are transmission mechanisms which do differ, and there are different phases of cycles. So I think it's really important to have ability on national level to react on those in order to sustain the financial stability. What I do agree on is that I think that we should have some level of unification between the principles, how do we use different kind of tools, and certain definitions could be unified. So I think that also in that sense, if we think about the spillover impacts between the countries of using the tools, reciprocation would be easier if the tools would be a little bit more unified form.
Thank you, Katja. And Marek, you said that you took up the complexity of macroprudential policies, and this is what we have discussed here during the day already, that macroprudential policies are complex, and you mentioned the reasons for that. But I want to ask a provocative question: that could you see that should it be more complex or should it be less complex? Because after all, capital is capital.
Sorry, could you repeat that?
Should it be more complex to have different tools for different purposes, or could it be more or less complex because capital is after all capital?
Well, I think macro policy should be rather complex, so we should have a rather complex view to see all possible sources of the risk, because as we discussed even before during different forums, I think financial stability or systemic risk is a very complex task. So it's very important to put different topics together and to have this complex view. And also in terms of tools, I think it's very important to extend the toolkit, because now we are very much focused on the banks. I know tomorrow we will have a presentation on non-banking financial institutions, also other areas. So it's very important to have even tools to potentially address these topics or these risks.
Yeah, thank you. And now I think that we still have a couple of minutes time. So if there are questions in the audience to our distinguished panelists, then please find the mic. I don't see any hands, but if there's someone who sees hands, please, and please state your name and the institution where you are coming from.
Tuomas Peltonen, ESRB.
You're welcome.
Many thanks for the very interesting panel. Actually, I have a question about now, what should we do given the current circumstances with macroprudential policy, and given of course the lessons that we have learned in the past. but also after what we learned in the US banking crisis. So what are the lessons that you take from there for the macro-pru policy making? And do you see, for instance, any need for liquidity tools? Thank you.
Thank you, Thomas. And could you specify which banking crisis of US do you refer to?
The last, the March.
Oh, the latest.
The latest.
Okay, latest. Okay. Who wants to answer?
I can maybe start.
Okay.
Thomas, there are different aspects of the crisis. In the March 2023, there is a bank run that's I already mentioned. For me, as I already mentioned, better understanding of the deposit side, but also corporate governance. That's a crucial topic because one of the lessons from this period is that even, not really sound bank, but bank that fulfill all regulatory requirements can fail within a few days because of the social media, because of other aspects. And here, this corporate governance is really a crucial topic. So take care of this, very important to have it in the mind. Second lesson is related to interest rate risk and also revaluation of the bond portfolio. I think there is a difference between the US and the EU. At the beginning, maybe market were punishing also EU banks, but now it's more clear that the system that we have here is very different. I know also in the first panel there was a discussion about HTM and potential issues with this portfolio. Well, from my perspective, I don't see it as a big risk. At least not just in Slovak banks, but also in general in the EU. I know that there are losses. Of course, there are losses, but keep in mind that in the previous period, when interest rates were going down, there were huge profits. And nobody cared about this before. And this could be, of course, potentially source of the risk, only in the scenario when there is an outflow of the deposits. But we have a LCR, and for the LCR purpose, HTM is in the fair value. So if you believe in the LCR, we should be in a relatively good position. Still, we should think that if banks are under pressure, they still have a central bank where can take some liquidity out of this. So maybe for the beginning.
Okay. Gediminas, would you like to continue?
Yeah, just a couple of thoughts on the question and on this US example and its effects on macro-pru. So let me begin like this. I'm not sure if that was really macroprudential measure or was it like microprudential measure, which was not solved because of the, so to say, regulatory differences in the US and et cetera, and maybe like prudent micro supervision would have solved the issue before you jump into the conclusions on the from the macroprudential perspective. But having said this, I think what was standing behind that, we are living in a changed world. So the slide I missed, I wanted to talk about the footprint of the climate change, the digitalization, and some other things we should take into account with change macroeconomic environment and change technological environment into our perspective in implementation of the macroprudential policies. So I'm not sure if it is about liquidity, and most likely we need to think also on the liquidity from the macroprudential point of view, but there are like new things which should be taken into account when considering macroprudential measures too.
Okay, thank you. Any other questions? I see two hands there. Could you please pass the mic?
Ricardo Correa, Federal Reserve. I think a few of you touched a little bit on the issue of communicating well. And so my question was whether financial stability communication has evolved to the point that it could match monetary policy communication. So for example, on the issue of forward guidance or the other type of monetary policy communication where you can influence markets just by communicating where you will be at some point in time. Have we seen that in the financial stability spectrum as well, where you, for example, as Mark was saying, you communicate that there are some risk here and that you could potentially use certain tools in a certain direction? Would that influence the behavior of agents, or we're not there, where communications are credible such that agents are going to react to whatever the macroprudential supervisors are communicating in that fashion?
Okay, thank you. And I think that, Javier, was it your hand? Okay, please. we try to remember those questions and then we find
Thank
who
you.
will answer.
And actually, I think very good that Ricardo was raising the issue of forward guidance, because I was going to raise it on the specific topic of the positive neutral rate for the CCYB. Several of you implicitly sympathize with that idea, while at the same time sort of noting that there is possibly some division of opinions in the macroprudential community on having a positive neutral. So my impression in terms of the cons of the positive neutral, though I think on the net I like the positive neutral, is that it will make this release crucial. So in a sense, it puts the discretion on the release and the timing some of you discuss, but then also on the when you will declare we are back to normal times and the buffer has to be rebuilt. In the current regime, the industry, the other players, could think of credit developments, informing them of when you will raise the rates. But if there is a positive neutral, one potential limitation to usability is that the banks are afraid of too quickly coming back to normal and then having to have the neutral rate. So forward guidance in the form of when we release the positive neutral, we will not raise it again for at least 3 years, could very much increase the effectiveness of the release, but at the same time might be tying your hands too much, right? So maybe a sort of in between forward guidance, but not full commitment because everything is database and so on is important. The second is recommending maybe a little bit on the complex, whether we want complex tools. I think, the task is very complicated, and the tax might require as complicated as needed, but no more. And I think in a cross-sectoral, cross-country perspective, which I think in Europe somehow we have to live with it, also with Latin harmonization, but maybe also from the empirical perspective of the first session, there is a danger that we keep accumulating so heterogeneous measures across countries that we are limiting the capacity to learn from how these measures are effective, no? Which will require like comparable and measurable measures to build a database with which to judge that. So maybe it's other things equal, let's go for the most harmonized and the simplest tool. Other things equal. If you need to justify a complex tool, okay.
Thank you. So we have issues, communication and positive countercyclical buffer and the complexity. Who wants to start? Katja and I, we don't have this positive neutral countercyclical buffer in Finland, so this is just wishful thinking for us, so we are just talking in theory. But Benjamin and then Gediminas.
Yeah, I have some sympathy with the positive neutral rate due to the political economy of raising rates. So there's definitely a benefit in there, and we were discussing this all through the past 8 years, whether it would be good to have them or not. But one important issue is that when is the release perceived as permanent? Because only if it is perceived as permanent, or to some extent as permanent, then it will give you the benefits of releasing. Otherwise, they will just behave as if the neutral rate is still there. And you have this the implication for the banking sector that they are in survival mode against the capital requirements. So that is one thing we are discussing internally, whether or not this is perceived and under which circumstances it is perceived as permanent enough that it will change behavior. And to your second question with complexity, I'm personally not in favor of adding more and more instruments to the toolkit. I think the more granular you get, the less you differentiate yourself from macroprudential supervision. And it makes it even harder to explain what is a macro perspective on things. So I personally think that having as very, very limited instruments, maybe one non-releasable systematic instrument and one cyclical instrument that can be released anytime is something that would be worthwhile doing for the banking sector, for example.
Thank you. And Gediminas, please.
Okay, I think you asked very good questions, and but let me begin with a bit more, so to say, distance or like introduction. So when I got interested into financial stability topic, there was no Macropru. It was 2003 or 4, and you know, internet is still in its initial phases, but the paper could found financial stability. I don't remember the author, but it was one of the first papers on financial stability, and I think it provided the best definition of financial stability. So what is financial stability? This is the situation which you know about when you have financial instability. After that, there were like many other definitions defined, evolved, but this one I found most so to say, clear for me. In 2018, we had a conference in Lithuania, international conference in Lithuania. Do we have any measurable target for macroprudential policies? And like asking, could it be real estate prices and their growth? The answer was more or less no, but eventually we also kind of concluded that we don't have this measurable target. As for instance, monetary policy has. This is what is price stability is defined like 2% inflation in the medium term. So in a way, then the question is about, and now I get back to the question, the communication or what about the positive neutral countercyclical capital buffer and how the markets could expect and when to expect when it's to be implemented. I would in a way ask in a similar fashion on how the monetary policy is. Policy is not automatic. It's not algorithm. So in a way that if you have projections, macroeconomic projections, whatever they are, so does the ECB should react according to the macroeconomic projections as such, or are macroeconomic projections a source of information for the decision, which is discretionary because it takes into account many more information? Very similarly for me is or kind of similarly is the neutral positive countercyclical capital buffer and its framework. What's very much needed, and I believe it's done, so that you have this all setup disclosed, how you come up to the decision, and how you take into account the growth of the economy, and is it close or not to the output gap, how do you take into account credit development, how to take into account bank profitability, etc., etc. But then this decision is not automatic, but the markets could expect if these conditions in a way are started being evident in the market. So the institutions may come up with a decision on let's say this capital buffer increase. But having said all this, here I agree, and it's also about the complexity of macroprudential policy, that we don't have this one single target or measure by which we could define we are successful in our policy implementation. So I think that's how it is. The other thing, the thing I would like to note, we talk about Macropru is that complex and complicated. There are so many aspects, many other policies. I believe we should reduce a little bit the complexity in our approach to it, because if we think it's all that so difficult and impossible, I mean, they would end up doing nothing. But the worst thing is to do nothing, I think. Yeah.
Okay, thank you. And very briefly, Katja, on communication.
Well, yeah, concerning the RV as far as the monetary policy, I think no. There are still things to do, and I think that we are in the phase of getting better understanding of the fundamentals in Macropru. The other thing related to the other question concerning the release of the buffer and especially the positive neutral, I think that one thing that we need to think still a bit more in balancing, creating space to the granting more loans and operability of the banks and then the resilience of the banks. So I think that there is releasing the buffers is never an easy question and when to do it. Thanks.
Okay, Marek.
Ricardo, can you hear me? Yeah. Ricardo, you asked a question about forward guidance, whether it's a part of our communication. Yes, it is. It is. It's very explicit when we are talking about CCYB. So every quarter when we decide on CCYB, we also publish forward guidance, what market can expect next quarter. I'm very explicitly saying how high is the probability that we will change it. It's less explicit, it's more implicit for a borrow-based measure because it's not a decision for every quarter. But if there are trends in the market and we see a rising risk, we simply indicate, okay, if you don't change this behavior, if you see these trends to continue, we can change something. We can come up with some solutions. So it's more implicit. And maybe one comment to positive, neutral CCYB. Well, we are, let's say, we are rather neutral to positive neutral. Neutral means that we like the concept as it is now. And it's also driven by the fact because the idea of the positive neutral is to create some macroprudential space buffers and then to release it. Well, in the past, we have been able to do it. So to raise buffers and even potentially release if necessary. By making this buffer positive neutral, you are basically shifting from cyclical tool to more structural tool. Slovakia is still, let's call it, emerging country. So there was a cycle, a strong cycle, and we expect that it will continue even in the future. I can imagine in some countries where indebtedness is already high, you do not expect the cycle will be strong. In these countries, it can be. There can be a reason to have it, but not really for us. Yeah. Because, again, we expect cycle can be strong, and I expect they will react again. Yeah. So we'll raise CCYB and in such way to create space for us.
Okay. Thank you, and thank you everyone, and thanks for our audience, thanks for our panelists. I don't even try to wrap up or list the main takeaways. I hope that you have been listening carefully. But I would like to take up one issue which Marek mentioned, and this goes for quite many things, is that in bad times we have to live with the decisions that we have been making when the times were good. So I think this goes with the macroprudential policies that we have to make the decisions in advance when we are hated and when everyone is asking that where do you guys live because you are making this kind of decisions. And it also goes also for credit granting, that the credits that are granted in the good times, then actually they are the ones where the credit risk is. So in that sense, I think that we have to take that into consideration. But with these words, I thank my panelists. Thank you so much. Thank you for your contributions. And I thank the audience. And this panel is now closed. And I think that there will be a coffee break next, so someone knows better than. But at least we are off. Thank you. Thank you.
Yes. Thank you very much. So again, just a few boring informations. Really, there is a coffee break. You can grab some coffee, tea outside, and we will try to continue at 3:30. So to be on time. Thank you very much.